Here's a brutal truth that will sting before it saves you. Most traders actively sabotage their biggest winners. They turn profitable trades into devastating losses through one catastrophic mistake. They add size at exactly the wrong time, in exactly the wrong way. This isn't a minor technical error or slight miscalculation. This is the fundamental flaw that separates those who consistently extract profits from markets and those who merely participate in an expensive hobby that slowly drains their accounts. Picture this scenario that plays out thousands of times every trading day. Tom spots a clean breakout in a growth stock at $50. The chart looks perfect, volume expanding, resistance broken with authority, all technical indicators aligned. He buys 1,000 shares, feeling confident about his analysis. His stop loss sits at $48, risking exactly 2% of his account. Everything looks professional at this point. The stock rockets to $55, confirming his thesis. The breakout holds. Momentum builds. And Tom feels the intoxicating rush of being right. Euphoria kicks in. This is where amateur psychology takes control. He doubles down, buying another 1,000 shares at $55. His average cost climbs from $50 to $52.50. At $60, greed whispers its poison. He adds 1,500 more shares. His total position, 3,500 shares, with an average cost of $55. When the inevitable pullback hits $52, he's underwater on what started as a winning trade. A position once profitable by $5,000 now shows a loss of $10,500. This is amateur behavior, and it's why 90% of retail traders lose money over time. They mistake early confirmation for permanent validation. They confuse temporary momentum with sustainable trends. Most destructively, they increase risk precisely when they should manage it most carefully. Tom's story isn't unique. It's the default pattern that destroys accounts across every market, time frame, and strategy. Professionals think differently. They follow Jesse Livermore's 1/3 Rule A, mathematical approach to pyramiding that protects capital while maximizing opportunity. The professional facing Tom's scenario would have bought 300 shares at $50, representing his largest position when conviction was highest and information freshest. At $55, confirming the breakout, he adds 200 shares smaller, reflecting increased risk of buying at higher prices. At $60 after further confirmation, he adds his final 100 shares, total position, 600 shares, with average cost of $53.33. Same pullback to $52 leaves him profitable by $1,000 instead of suffering devastating loss. The mathematics are stark and unforgiving. The amateur's approach creates weighted average costs that rise with each addition, making positions increasingly vulnerable to normal market fluctuations. The professional's inverted pyramid creates lower average costs that provide protection against the very pullbacks that destroy amateur traders. But numbers tell only part of the story. The psychological protection proves even more valuable. The difference isn't luck, it's identity. Amateurs chase momentum with their largest positions, driven by emotional highs of being right and fear of missing further profits. They operate from scarcity mindset that says opportunities are rare and must be maximized when they appear. This leads to catastrophic error, increasing position size as prices move away from initial entry, creating maximum vulnerability at minimum conviction levels. Professionals build inverted pyramids, risking most when they know least about how trades will develop, risking least when trades have already moved significantly in their favor. This acknowledges fundamental market truth. The further a stock moves favorably, the greater mathematical probability of reversal or consolidation. Professional traders understand their best information and clearest thinking occur at trade beginnings, not after substantial moves. The professional approach serves as psychological armor against emotional volatility that destroys trading accounts. When you risk most at best prices with clearest conviction, you withstand normal market fluctuations without panic. When you risk progressively less as prices extend, you protect against euphoria-driven mistakes that turn winners into losers. This isn't just risk management, it's emotional engineering designed to work with human psychology, not against it. Here's the maxim you can write on your monitor. Add less as you win more. Another. Good trades pay you to be patient. Bad trades demand attention. And one more. If you must ask whether to add, you probably shouldn't. But here's what most traders miss. The 1/3 rule isn't just about position sizing. It contains 3 hidden protocols that separate those who survive from those who merely participate. These protocols address timing of additions, confirmation required for each add, and exit strategy that locks profits while maintaining exposure to larger moves. Master these, and you'll understand why Livermore could pyramid into positions worth millions, while others went broke chasing identical moves. The first protocol involves precise mathematical calculations that most traders get catastrophically wrong. It's not enough to simply divide intended positions into thirds. You must understand optimal position sizing for your account, volatility adjustments, and maintaining proper risk ratios as you add. Mathematics must account for total account size, risk tolerance, stock volatility, and distance to stop loss. Get these calculations wrong, and even the 1/3 rule becomes dangerous. The second protocol governs timing and confirmation required for each addition. Amateur traders add based on price movement alone, mistaking temporary momentum for lasting confirmation. Professional traders require specific technical and volume confirmations before each add, ensuring they respond to genuine market signals rather than noise. This protocol prevents impulsive additions that destroy promising trades. The third protocol addresses exit strategy most traders completely ignore. How you exit pyramided positions matters as much as how you build them. Amateurs sell everything at once, usually at worst possible times. Professionals reverse the pyramid on exit, taking profits from highest cost positions first while maintaining exposure through lowest cost shares. This locks momentum profits while preserving ability to capture larger moves. These 3 protocols transform pyramiding from dangerous gamble into mathematical edge that compounds profits while protecting capital. They represent the difference between trading with hope versus precision, gambling on momentum versus systematically extracting profits from market inefficiencies. The amateur fights psychology through willpower alone. The professional designs systems that make right choices easy choices. Remember the numbers, because numbers keep us honest. At 300 heltreds, 200 femoheltreds, 800 etrids. Average cost sits at $53.33. Pull back to $52 stays green. Flip to equal adds and invite disaster. Flip to larger adds and invite ruin. The market will test your method, that's certain. When you follow the 1/3 rule, you answer without words. I am here to stay, not to play. Amateurs build pyramids like monuments, heavy base, narrow top. They follow ancient architectural principles that create impressive structures but catastrophic trading positions. When they add to winning trades, they commit their largest capital at points of maximum uncertainty, then double down on hope as prices rise, amplifying exposure precisely when mathematical risk peaks. Professionals build them inverted, with mathematical precision that acknowledges a fundamental market truth. The further a stock moves in your favor, the greater the statistical probability of reversal or significant pullback. This isn't pessimism, it's probability mathematics that separates systematic profit extraction from expensive gambling. Here's the exact protocol that transforms pyramiding from speculation into systematic edge. You identify your total intended position size through rigorous calculation, not emotional guesswork. This maximum allocation derives from your account size and predetermined risk per trade, never negotiable, never adjusted mid-position based on how good the setup looks. Once you establish that ceiling, you divide exposure into thirds, following specific mathematical progression. Your first entry represents your largest commitment, typically 60% of maximum intended position, deployed when price action and technical analysis provide highest conviction. Consider Sarah, operating with disciplined precision on a $100,000 account. She maintains strict 1% risk per trade, meaning absolute maximum loss on any position cannot exceed $1,000. She identifies Apple breaking from months of consolidation at $180, volume surging with institutional characteristics. Breakout occurring at pivotal technical resistance. Her stop loss sits at $175. If AAPL falls below this level, her thesis invalidates completely. This creates $5 risk per share. With her $1,000 risk budget, maximum theoretical position equals 200 shares. This represents her total intended exposure, not her initial entry. Following the 1/3 rule precisely, Sarah enters 120 shares at $180, exactly 60% of maximum position. This isn't arbitrary mathematics. She commits most capital when analysis is freshest, emotions calmest, and information quality highest. Her initial outlay, $21,600. The market validates her thesis as AAPL pushes to $185, confirming breakout with expanding volume and successful retest of $180 support. With growing conviction and trade already profitable, she adds second tranche, 60 shares at $185, committing $11,100. The stock continues ascending to $190. After consolidation and definitive momentum expansion, confirming trend strength, she adds final tranche, 20 shares at $190, investing $3,800. Total position, 200 shares for $36,500 capital commitment. Her average cost calculation, $SEC, 120 times $180 plus 60 times $185 plus 20 times $190. 200 equals ASAC $21,600 plus $11,100 plus $3,800. 200 equals SAA $36,500. 200 equals $182.50 Compare this mathematical precision to Mark's amateur approach. Despite knowing pyramiding concepts exist, Mark chooses equal position sizing because it appears simpler. He buys 67 shares at each level, $180, $185, $190. His average cost climbs to $frac 67 times $180 plus 67 times $185 plus 66 times $190. 200 equals FAC $12,060 plus $12,395 plus $12,540. 200 equals $184.975. Dollar. The mathematics prove themselves when markets test positions. When AAPL experiences normal pullback to $186 routine, 2% correction, occurring regularly in trending stocks, Sarah maintains $700 profit, while Mark shows barely $200. Sarah's position provides $3.50 cushion before reaching average cost. Mark's offers merely $1.02 buffer. This difference compounds dramatically over time, creating wealth for systematic traders while slowly destroying accounts that ignore mathematical principles. The numbers represent only half the equation. The psychological engineering proves equally valuable for long-term success. The 1/3 rule forces maximum capital commitment. When analysis is freshest and emotions are calmest, typically at trade initiation, before profits or losses create emotional turbulence, clouding judgment. Each subsequent add occurs when you're already profitable, but position size shrinks as emotional investment grows. This isn't merely risk management, it's behavioral architecture designed to work with human psychology rather than against it. Think about emotional protection this structure provides. Your largest position, established at best price with clearest thinking, generates most profit as stocks move favorably. Smaller additions, made at higher prices with increased emotional involvement, contribute less to overall returns, but don't create devastating losses if positions reverse. This allows confident trading because biggest risk occurs when you possess most information and clearest conviction. The system prevents emotional spirals, destroying most accounts. When positions move favorably, amateur traders feel validated and increase sizes, often doubling down at extended levels. This creates maximum vulnerability precisely when mathematical risk peaks. The 1/3 rule forces opposite behavior, smaller positions as prices extend, creating protection against euphoria-driven mistakes that transform winners into devastating losses. Consider psychological differences between Sarah's systematic approach and typical amateur behavior. Sarah knows maximum position size before entering trades. She commits largest exposure at best prices, then systematically reduces size as stocks move favorably. Her emotions remain stable because systems make decisions, not feelings. She withstands normal market fluctuations because mathematics provide protection, not hope or willpower. Amateur traders typically start small, then increase position sizes as stocks move favorably and emotions intensify. This creates maximum vulnerability at minimum conviction levels, exactly backwards from optimal trading psychology. When inevitable pullbacks occur, amateurs face devastating losses on positions established at worst prices with highest emotional investment. The mathematics become unforgiving. Higher average costs, reduced cushion, increased stress, forced liquidation at terrible times. But mathematical precision extends beyond basic position sizing. Your stop loss isn't guesswork, it derives from structure and volatility characteristics. If Apple's average true range measures $2.50, structural stops might sit 2 ATRs below pivotal points, rather than arbitrary round numbers. If breakout occurs at $180 with pivot at $178, proper stop could be $173. Not $175. This increases per share risk to $7, reducing maximum shares to approximately 142. Your tranches become 85, 43, 14. Same framework, adapted mathematics. Volatility expanded, so size contracted proportionally. The protocol also demands understanding net risk evolution as you add positions. After Sarah's initial 120 shares at $180 with $175 stop, she risks $600 of her $1,000 budget. When price rallies to $185 and confirms, she adds 60 shares. Does risk jump to $900? Not if she raises stops under new structural support. If proper retest forms higher floor at $182, she lifts stops for all shares to $181.40. New risk, $1.60 on 180 shares equals $288. She freed risk capacity while improving probabilities, the secret of safe compounding. Average cost becomes tool, not trophy. Professionals track blended basis and distance to stops after each addition. Suppose blended cost sits at $182.50 with structural stop trailing under last pivot at $179.50. Per share downside equals $3. Holding 200 shares creates $600 gross risk, well under budget. This frees consideration of next addition only if confirmation appears and momentum warrants. If not, you wait. Waiting is a position. Amateur asks, what can I make if it continues? Professional asks, what will I lose if it stops here? Remember these survival mathematics. 60% of intended position on initial entry, 30% on second addition, 10% on final addition. These aren't arbitrary percentages, they represent optimal balance between conviction and caution, between maximizing opportunity and protecting capital. When you follow mathematical principles consistently, you join the small percentage extracting profits from market chaos while preserving capital for next opportunities. The critical question becomes timing. When exactly do you pull trigger on second and third editions? This transcends price movement alone. Amateur traders make that mistake and get destroyed by false breakouts and temporary momentum. Professional timing requires reading what Livermore called the tape's true intention distinguishing. Genuine institutional accumulation from mere technical noise that fades quickly. Most traders mistake early momentum for lasting confirmation. They witness a modest bounce off support, observe slight volume expansion, feel psychologically validated by initial price movement, and commit too much capital too soon based on insufficient evidence. This represents the fundamental error that transforms promising setups into devastating losses. The market specializes in noise, false starts, and sophisticated head fakes specifically designed to separate impatient traders from their capital. Every trading day, thousands of breakouts fail within hours, momentum fades by afternoon, and apparent confirmations reveal themselves as temporary technical noise, rather than sustainable institutional moves. Your job as a professional is different. You filter motion from meaning, distinguishing genuine market signals from the beautiful lies that drain accounts systematically. The amateur trader operates from scarcity psychology, believing opportunities are rare and must be maximized immediately when they appear. This creates urgency that overrides analytical discipline, leading to premature position sizing based on hope rather than evidence. They see initial price movement as validation of their thesis, then increase exposure before markets provide genuine confirmation of sustained directional intent. They chase price like tourists chasing buses, always arriving after the best seats are taken. This backwards approach, committing maximum capital on minimum evidence, explains why retail traders consistently lose money despite occasionally identifying correct directional moves. Jesse Livermore understood market psychology implicitly through decades of speculation that built and destroyed multiple fortunes. He didn't simply look for price movement. Any stock can bounce temporarily or break resistance briefly before failing. He looked for what he termed pivotal points, clear, undeniable breaks from established ranges or trends, accompanied by specific volume, characteristics, and time-based validation that revealed the market's true institutional intention, not its fleeting retail-driven whims. Pivotal points represent moments when significant capital commits to directional moves, creating momentum that sustains beyond initial technical breakouts. For Livermore, conviction wasn't feeling it, was scientifically observed, confluence of price, volume, and time working together to tell coherent stories. Modern markets operate with increased complexity through algorithmic trading, high-frequency programs, and sophisticated institutional strategies. But underlying principles remain unchanged. Institutional money moves markets, not retail enthusiasm. When large funds accumulate positions methodically, they create volume signatures, price patterns, and time-based behaviors that distinguish genuine moves from temporary noise designed to shake out weak hands. Professional traders learn to recognize these institutional fingerprints before committing significant capital to pyramiding strategies. Amateur traders chase price movement without understanding underlying institutional activity, driving sustainable trends, then wonder why their technical analysis fails repeatedly. Watch this critical discipline unfold through Rachel's pharmaceutical trade, a masterclass in systematic confirmation. She identifies a biotech stock, consolidating at $25 after months of decline, institutional ownership increasing based on quarterly filings, catalyst events approaching with FDA approval timeline, creating fundamental backdrop for sustained move. Technical analysis shows clean breakout above 6-month resistance, with expanding volume and successful retest of previous highs. She enters first third of intended 600-share position. 300 shares at $25. Her maximum risk budget allows this total exposure based on stop-loss placement at $23, creating $2 per share risk within her strict account parameters. The stock immediately rallies to $28, generating $900 unrealized profit and validating her analytical thesis. Every psychological instinct screams to add more shares immediately. Momentum feels unstoppable. Price action appears to confirm her analysis perfectly. This represents the most dangerous psychological moment for amateur traders, when initial success creates overconfidence, leading to premature additions that destroy otherwise profitable trades. The amateur would double down here, buying another 300 shares and transforming inverted pyramid into dangerous monument structure vulnerable to normal pullbacks. But Rachel waits, applying systematic confirmation criteria before considering second edition. She asks 3 questions that save professionals millions annually. Does the stock hold $28 during normal, intraday fluctuations, or is strength temporary? Does volume dry up on pullbacks, indicating lack of selling pressure, or expand, signaling institutional distribution? Are buyers stepping in consistently at higher levels, creating genuine accumulation patterns rather than temporary momentum driven by retail speculation that typically exhausts quickly? These represent professional questions, not amateur impulses. Professional confirmation requires 3 specific elements working simultaneously, not individually. First, price must hold above breakout levels during multiple sessions, not just single candles. Many breakouts hold briefly before failing when institutional support proves insufficient. True confirmation means consolidation above prior resistance, establishing new equilibrium where previous ceiling becomes reliable floor. Second, volume characteristics must support price movement through specific patterns. Expansion on advances indicating institutional accumulation, contraction on declines showing lack of selling pressure. Block trades occurring consistently on upticks, rather than random intervals, suggesting large money deployment. Third, time-based validation proves most critical, yet most overlooked by impatient traders. Genuine breakouts sustained momentum over multiple sessions, while false breakouts typically fail within days as retail enthusiasm exhausts limited capital. Rachel observes the stock consolidating above $28 for 3 full trading sessions. During this period, she analyzes volume patterns systematically. Pullbacks to 27.50 occur on diminishing volume, suggesting limited selling pressure from institutions or informed money. Rallies back toward 28.50 show expanding participation, indicating genuine accumulation rather than short covering or momentum chasing by retail participants. Most importantly, institutional block trades appear consistently on upticks throughout the consolidation period, confirming large money supports the move, rather than retail momentum, driving temporary price action that fades when enthusiasm wanes. Order flow analysis reveals tight spreads at highs, committed bids refreshing after sell programs, and higher lows on intraday pullbacks without panic prints or trapped long liquidation. The tape speaks softly first through these subtle signs, loudly last through obvious breakouts that attract amateur attention after smart money has positioned. Only after comprehensive confirmation price holding above breakout level for adequate time period. Volume patterns supporting sustainable institutional accumulation, rather than temporary retail enthusiasm, and block trade activity continuing rather than fading. Does Rachel add her second third? 200 shares at $28.50. Her average cost now calculates to $26.50, with total position of 500 shares. This mathematical precision, 300 25 kablelis, nullis nullis nullis. 200 28 kablelis, 50, 57, 500, 1500, trailika, 200 500, 26, 45 320, 5 kablelis nullis nullis, plus 128, kablelis 50, 507, 500 plus, 500 plus, $13,200 equals $26.40. This disciplined approach requires patience that separates professional from amateur trading psychology. Waiting is a position that pays dividends through reduced risk and improved entry points. The amateur fights time, believing speed equals profit. The professional uses time as confirmation tool, allowing markets to prove sustainability before increasing exposure. This patience proves invaluable when markets test discipline through inevitable volatility that destroys impatient traders. Rachel's systematic patience saves substantial capital. When markets deliver their predictable test the following week, the stock spikes to $32 on speculation about accelerated FDA approval, creating massive unrealized profits and enormous psychological temptation to add final tranche immediately at extended levels. Amateur traders would Load maximum position here, driven by fear of missing further gains and validation bias from substantial profits. Social media erupts with celebration, chat rooms buzz with predictions of $40 targets, and momentum feels unstoppable to emotional participants. Her systematic patience saves her when the stock experiences violent reversal that destroys momentum chasers. Initial spike to $32 proves unsustainable when FDA announces standard review timeline rather than accelerated approval. The stock collapses to $26 within 2 trading sessions, wiping out speculative gains and testing structural support that separates genuine accumulation from temporary speculation. Rachel's disciplined approach kept total position manageable at 500 shares with average cost of $26.40, generating modest profit even during sharp reversal. Momentum chasers who added maximum positions at $32 suffered devastating losses, transforming winning trades into account, damaging disasters that require months to recover. Each addition throughout systematic pyramiding requires 3 confirmations working simultaneously. Price action holding above breakout levels during normal market fluctuations. Volume characteristics, supporting sustainable institutional accumulation rather than temporary retail enthusiasm. And time-proving breakouts weren't temporary flukes destined to fail quickly. Missing any single element transforms systematic trading into gambling, regardless of how compelling initial setups appear to emotional participants. True confirmation represents markets speaking clearly through coordinated signals, not whispering promises through isolated technical events. This 3-part confirmation system adapts to different market environments and timeframes while maintaining core principles that protect capital. In volatile markets, time-based confirmation might require extended periods, 5 sessions rather than 3 before adding positions as normal fluctuations increase. In trending markets with strong institutional participation, volume confirmation shows different characteristics, but maintains same underlying principle of distinguishing genuine accumulation from temporary noise that attracts amateur participation. Volume analysis extends beyond simple expansion and contraction patterns that most technical analysis teaches. Professional traders examine order flow characteristics, block trade frequency, institutional versus retail participation ratios, and accumulation distribution patterns that reveal true market intention behind price movements. When large institutions accumulate positions systematically, they create specific volume signatures: consistent buying on weakness, measured selling on strength, block trades occurring at strategic price levels rather than random intervals, and tight spreads indicating committed participation rather than air pockets. Price confirmation requires understanding structural support and resistance levels that matter to institutional participants who move markets with size. Round numbers like $30 or $25 often attract retail attention but prove less significant than institutional cost basis levels. Option strike concentrations, or previous accumulation zones, where large money established positions over time. Professional confirmation focuses on levels that matter to participants who move markets, not psychological levels that attract retail speculation without substance. Time-based validation acknowledges that sustainable moves require institutional participation that develops over multiple sessions, rather than single-day events driven by news or momentum. Retail-driven moves typically exhaust quickly as limited capital gets deployed rapidly through emotional decisions. Institutional moves develop systematically as large funds deploy capital methodically over extended periods, creating momentum that sustains beyond initial technical breakouts and survives normal market corrections. Here's your confirmation protocol. When elements align properly, add only after price holds above breakout on closing basis for minimum 3 sessions. Add only when volume expands on thrusts and contracts on pauses, indicating institutional sponsorship rather than retail speculation. Add only after time denies failed move through sustained strength that survives multiple tests. Then adjust stops intelligently beneath highest confirmed higher low, not arbitrary levels. Recalculate total risk against combined shares, ensuring position sizing remains within account parameters. Your goal stays constant: Increase exposure while decreasing vulnerability through mathematical precision. Remember these survival maxims you can write on your monitor. Add less as you win more. Good trades pay you to be patient. Bad trades demand immediate attention. If you must ask whether to add, you probably shouldn't. Trade with sponsors, not with tourists. Waiting is a position that compounds returns. These aren't motivational slogans, they represent mathematical truths discovered through decades of systematic observation and capital preservation. But here's the paradox that destroys most pyramiding attempts and separates systematic traders from gamblers chasing momentum. As trades become more profitable and momentum builds convincingly, mathematical risk of adding positions actually increases rather than decreases. Extended prices carry higher reversal probabilities based on statistical analysis of market cycles. Profitable positions create emotional attachment that clouds analytical judgment through confirmation bias. Momentum attracts maximum retail participation precisely when smart money begins. Systematic distribution to willing buyers. This creates the most psychologically dangerous moment in any pyramiding sequence, when final third additions become most tempting, exactly when they become most mathematically risky. The next chapter reveals how professionals navigate this treacherous territory, where discipline meets destiny, and fortunes are made or lost through systematic execution of the smallest, most critical position addition. The third ad is where fortunes are made and lost, where systematic discipline confronts maximum psychological pressure, and where the difference between professional and amateur trading psychology becomes most brutally apparent. By this critical juncture, you're already profitable from methodical position building. The market has confirmed your analytical thesis twice through sustained price action, expanding volume, and time-based validation. Momentum is building convincingly, creating the intoxicating sensation that profits are inevitable and unlimited. Every fiber of your psychological being wants to load maximum size on what feels like easy money. The surest thing you've seen in months. This represents the exact moment where amateur psychology becomes lethal to long-term account survival. The amateur, driven by greed and fear of missing additional profits, abandons systematic position sizing precisely when mathematical discipline matters most. They double down at extended levels, commit maximum capital when statistical reversal probabilities peak, and transform methodical pyramids into dangerous monuments vulnerable to normal corrections. The professional approaches the final third with surgical precision that acknowledges both opportunity and mathematical reality. This isn't about greed, it's about capturing acceleration while maintaining the mathematical safety that protects capital during inevitable market corrections. Consider David's Microsoft pyramid, a masterclass in systematic execution under psychological pressure. He initiated position building at $300 with 300 shares, representing 60% of his intended 500-share maximum based on rigorous account management. When Microsoft confirmed the breakout at $310, he added 200 shares following proper confirmation protocols. Now the stock approaches $320, generating substantial unrealized profits and enormous psychological temptation to maximize exposure. The amateur would abandon discipline here, buying another 500 shares and creating dangerous monument structure. David adds exactly 100 shares at $320, his smallest position throughout the entire sequence. His mathematical precision, trishimtait, 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 90 nulis plus 60 do 60. Nulis, 306, kablelis 60, septini 6, šimtai 300, 200, 210, vienas šimtas, 320, 600, $90,000 plus $62,000 plus $32,000 equals $306.67. Why commit minimum size at maximum prices when momentum appears strongest? Because he understands that the final ad captures the momentum phase, not the foundation phase. Foundation building occurs at breakout levels, when institutional accumulation creates sustainable support. Momentum phases represent acceleration periods when retail participation peaks and smart money begins distribution to willing buyers at extended levels. When Microsoft rockets to $335, David's inverted pyramid delivers massive profits while maintaining mathematical protection. His total unrealized gain, approximately $17,000 with substantial cushion against reversals. When the stock experiences normal correction to $325 routine pullback occurring regularly in trending markets, he remains profitable, while equal-sized pyramids show losses. The final third operates under different rules that acknowledge its speculative nature within systematic frameworks. Your first two editions can be patient and methodical, waiting for comprehensive confirmation. The third must be swift and decisive. You're capturing momentum acceleration, not building sustainable positions. Professional. Timing requires predetermined execution levels established before emotional pressure peaks. David set his $320 trigger in advance, based on technical analysis and mathematical calculations. Here's your exact protocol. Set structural trigger requiring fresh range expansion through pivotal point to new highs. Demand volume confirmation of at least 120% of 20-day average, with block prints on upticks. Require time filter showing strength persisting through first 90 minutes, then holding above breakout into close. Establish slippage guardrails with average spread under 2 ticks and sufficient order book depth. Ensure combined drawdown to raise stops cannot exceed risk budget. If any element fails, the ad fails completely. When price reaches predetermined level with proper confirmation, execute immediately without hesitation or second guessing. If confirmation fails to materialize within your time window, abandon the addition entirely, rather than forcing trades based on emotional attachment. This systematic approach prevents analytical paralysis that destroys accounts when psychological pressure peaks. Remember, doing nothing is sometimes the best trade. The final third is optional and must earn its way into your portfolio. Risk control tightens dramatically in the momentum phase. Your stop loss belongs under the most recent higher-low defining acceleration, not original breakout levels. If Microsoft cleared 320 and thrust to 324, define risk beneath 320 using structure +1 to 1.5 average true range. This keeps the final tranche on short leash for immediate ejection if momentum fails. But real mastery lies in exit strategy that most traders completely ignore until forced liquidation occurs. Professionals reverse the pyramid when exiting, selling highest cost positions first, while maintaining exposure through lowest cost shares. This systematic approach serves multiple purposes: reduces position size as stocks become extended, locks profits from speculative components, and maintains exposure through best-priced shares. David's exit unfolds systematically as Microsoft reaches extended levels. First out. Final third of 100 shares at $335. Banking pure momentum profit of $1,500. This locks speculative gains from highest risk component while reducing total position size. Second out. Middle edition of 200 shares at $340. Capturing $5,000 profit representing bulk gains from systematic building. The core position of 300 shares, purchased at best price with highest conviction rides for larger trend development, protected by trailing stops. This exit strategy acknowledges market reality that trends develop in phases, requiring different strategies. Foundation phases reward patient accumulation at good prices. Acceleration phases reward swift momentum capture. Distribution phases punish late participation while rewarding systematic profit-taking. The professional adapts strategy to market phase, rather than applying single approach, regardless of conditions. The mathematical advantage compounds over time through systematic execution. When you sell weakness from highest cost positions while holding strength from lowest cost positions, you allow winners to compound while preventing losers from creating devastating damage. The amateur sells strength and holds weakness, driven by psychological biases guaranteeing long-term failure. The professional does the opposite, through systematic protocols working with market mathematics. Your complete framework. Start with predetermined level based on technical analysis. Execute immediately when confirmation aligns or abandon entirely. Size positions smallest of 3 tranches, typically 10 to 20% of total exposure. Plan exit before entry, not during. Emotional pressure. Bank momentum profits first. Maintain core positions longest. Trail stops on remaining shares to capture extended moves while protecting accumulated gains. Before placing any final add, build pre-commitment checklist. Structural trigger. Fresh range expansion through pivotal point. Volume confirmation. Minimum 120% average with institutional characteristics. Time filter. Strength persisting through session with clean close above breakout. Slippage protection. Tight spreads with adequate liquidity depth. Risk parameters. Combined exposure within predetermined budget limits. Professionals would rather miss moves than finance drawdowns. The psychology matters as much as mathematics. The final third forces you to risk least when emotional investment peaks, creating protection against euphoria-driven mistakes. Your largest position, established at best prices with clearest thinking, generates most profit as stocks move favorably. Smaller additions contribute less to returns but don't create devastating losses during reversals. This allows confident trading because biggest risk occurs when you possess most information and conviction. Remember these maxims you can write on your monitor. Add less as you win more. Rent speed, don't marry it. Bank momentum, hold foundation. Sell your mistakes quickly. Ride your winners systematically. The tape is judge. Your opinion is jury. Confirmation matters most when greed is loudest. These aren't motivational slogans. They represent mathematical principles discovered through decades of systematic observation. All systematic approaches ultimately come down to identity. The amateur needs the final third to feel smart. The professional uses it to get paid systematically. One worships outcome, the other obeys process religiously. Your job becomes consistency with boring rules that compound returns over time. The 1/3 rule makes right action the easy action, largest when uncertainty is, lowest, smaller when extension is greatest. You trade what exists, not what you hope develops. The complete system transforms pyramiding from dangerous gambling into mathematical edge that compounds returns while preserving capital. Master this discipline where fortunes are made and lost, and you join the small percentage extracting profits from market chaos systematically. The next chapter reveals why systems beat willpower when pressure rises, and why designing rules in cold markets keeps you disciplined when heat builds. If the final third taught you anything, let it be this. Add small, add late, exit first, protect the core, bank the surge, then step aside and let patience build your next pivotal point. The 1/3 rule isn't ultimately about mathematics, it's about psychology engineered into systematic execution. Every element of this framework is designed to work with human nature, not against it. Acknowledging that traders are emotional beings who make predictable mistakes under pressure. The genius lies in forcing you to risk the most when your conviction is highest and your information is freshest, then automatically reducing risk as emotional investment grows and analytical clarity diminishes. This isn't accidental design, it represents decades of market observation showing how successful traders navigate psychological pressures that destroy amateur accounts systematically. Think about the profound psychological protection this provides when trades inevitably go wrong. When you're wrong on a position, the damage comes primarily from your largest allocation, which was established at the most favorable price, with the clearest thinking and lowest emotional involvement. Your smaller additions, made at higher prices with increased emotional investment, create minimal damage even during complete failures. This isn't just risk management. It's psychological engineering that allows confident trading without the paralyzing fear that destroys most retail participants. The system acknowledges fundamental human psychology that willpower fails under pressure. When trades move favorably and profits accumulate, every instinct screams to maximize exposure through larger position sizes. Greed whispers that opportunities are rare and must be exploited completely. Fear suggests that missing additional profits represents failure. These emotions, while natural, consistently lead to catastrophic decisions that transform winning trades into devastating losses through poor sizing at extended levels. Consider two traders facing identical breakouts. Tom relies on willpower and coffee, telling himself he'll manage risk later when emotions surge. Sarah relies on predetermined checklists that remove emotional decision-making from critical moments. When price rockets through resistance and chat rooms explode with excitement, Tom feels validation and adds his largest position at extended levels. Sarah breathes, consults her framework, and executes only her smallest final third if confirmation aligns. Their difference isn't intelligence, it's architecture. Tom hopes he'll be strong later when pressure peaks. Sarah removes moments where strength would be required. But mastery requires more than understanding mechanics. It demands absolute discipline in systematic implementation that transcends emotional impulses. Your position sizing must be predetermined and non-negotiable, calculated during calm periods when analytical thinking is clearest, not adjusted based on how compelling setups appear during emotional trading sessions. Your confirmation criteria must be objective and measurable: 3 closes above breakout levels, volume at minimum 120% of average on thrusts, pullbacks on contracting volume, spreads inside normal ranges for liquid names. Your exit protocols must be systematic and emotionless, planned before positions are established rather than decided during stressful periods when profits or losses cloud judgment. The amateur makes these critical decisions during maximum emotional pressure. The professional makes them during calm preparation, then executes mechanically, regardless of emotional state during trading sessions. Here's your complete framework that transforms psychological understanding into practical execution. Start with 60% of your intended position at initial breakout, representing maximum commitment when analytical conviction is highest and emotional involvement lowest. This foundation receives most capital because it's established with best information, clearest thinking, and optimal price levels, providing maximum protection during inevitable corrections. Add the second, third, 30% of total, only after price holds above breakout levels for multiple sessions, with supportive volume indicating genuine institutional accumulation, rather than temporary retail momentum. This confirmation requirement prevents premature building based on emotional impulses disguised as analytical insights. The waiting period allows markets to prove sustainability, while protecting against false breakouts that trap amateur traders. Add the final third, 10% of total, only during clear momentum acceleration, making it your smallest position throughout the sequence. This captures speculative profits while maintaining mathematical protection through minimal size at maximum prices. Exit in reverse order, taking momentum profits first, while maintaining core exposure through best-priced shares. Remember these survival principles that separate systematic success from emotional failure. Cut losses fast through predetermined stops established before emotional pressure builds, not arbitrary levels chosen during stress, when clear thinking becomes impossible. Size positions small initially, allowing methodical additions based on confirmation rather than large commitments based on analytical overconfidence. Wait for undeniable confirmation before each add confirmation. It isn't feeling good about trades. It's observing specific price action and volume characteristics indicating institutional support. Own your process completely, trusting mathematical frameworks over emotional impulses that feel compelling but lead to systematic destruction. The psychological framework extends beyond position sizing into complete identity transformation. The amateur identifies with individual trade outcomes, experiencing emotional highs during winners and devastating lows during losers. This creates inconsistent execution, as psychological states fluctuate with temporary results. The professional identifies with systematic process execution, measuring success through adherence to predetermined protocols, rather than individual outcomes. This identity shift proves crucial, because markets guarantee individual trades will fail regardless of analytical quality. Professional traders expect losses as normal business expenses, while maintaining confidence in systematic approaches, generating positive expectancy over multiple sequences. Amateur traders view losses as personal failures, requiring emotional recovery that disrupts systematic execution. Your development requires understanding that markets transfer money from emotional participants to systematic participants. Every emotional decision increasing size during profitable periods, holding losing positions hoping for recovery, abandoning protocols during stress benefits. Systematic traders who exploit these predictable patterns through disciplined mathematical frameworks. Environment design determines execution quality. When pressure peaks, build friction around impulsive actions and flow around rule-based decisions. Remove hotkeys for adding size beyond predetermined levels. Require typed confirmation for any deviation from your plan. Create a battle card on your desk. Risk per trade, maximum drawdown, add criteria, exit sequence, and your mantra when tempted. Waiting is a position that pays. Dividends. Use alerts instead of constant screen watching for level notifications. During trading sessions, keep your checklist open, not social feeds. After trading, open your journal to adherence sections first, profit and loss second. Weekend reviews should replay best and worst sequences, annotating where systems held and where you bent. Adjust checklists, not ambitions. Stress inoculation belongs in your preparation toolkit. Before markets open, rehearse worst plausible scenarios, slippage on entry, gaps against positions, false breakouts, platform failures. Pre-write systematic responses. If first close prints under breakout levels, you cut ads and reassess. If volume swells on pullbacks, you wait for drying before action. If spreads widen beyond parameters, you cancel momentum ads. This conditioning creates calm because your mind has processed scenarios already. The amateur fights psychology through willpower alone, creating internal battles that guarantee eventual failure. When emotional pressure exceeds mental resources, the professional designs systems making right choices easy choices, eliminating psychological battles through predetermined protocols that remove emotional decision-making from critical execution moments. Master the 1/3 rule systematically, and you join the small percentage extracting profits from market chaos, while preserving capital for continuous opportunities. This isn't about perfection, it's about systematic execution that compounds small edges into substantial wealth through disciplined adherence to mathematical principles, working with psychology rather than against it. Your transformation from amateur to professional requires abandoning emotional decision-making for systematic protocols, protecting capital while capturing opportunities. The 1/3 rule provides this framework through position sizing, acknowledging psychological realities while maintaining mathematical protection. Execute consistently, and you transform trading from expensive gambling into systematic wealth building, surviving all market conditions. If this clarified how to add to winning trades safely while managing psychological pressures destroying most accounts. Our next lesson on the art of doing nothing. Why inaction beats action 80% of the time will deepen your understanding of market patience and position management, separating professional systematic execution from amateur emotional participation.